$847 billion. That's the number buried in bank balance sheets right now. Not speculation, not estimate, actual reported losses. Losses they don't have to recognize, losses they're allowed to hide until they can't hide them anymore. And when that moment comes, it won't be one bank failing, it'll be dozens. Let me be very clear about what this number represents. $847 billion in unrealized losses. Unrealized. That's the key word. It means the losses exist. They're real. They're measurable. But under current accounting rules, banks don't have to admit they exist. They can pretend the losses aren't there, as long as they don't sell the assets, as long as they hold them to maturity. The fiction continues. But here's the problem. That fiction only works in calm markets. When depositors trust the bank, when liquidity is stable, when nobody's asking questions. The moment someone pulls the thread, the entire thing unravels. And we've already seen it happen. March 2023, Silicon Valley Bank, the 16th largest bank in the United States, $209 billion in assets, profitable, well-capitalized on paper, investment-grade rating. And it collapsed in 48 hours. 48 hours. What happened? Unrealized losses. Silicon Valley Bank held $120 billion in bonds, long-term treasury bonds and mortgage-backed securities. They bought them in 2020 and 2021 when interest rates were zero. Safe assets, government-backed, zero risk, except for one thing, interest rate risk. When rates go up, bond prices go down, always, without exception. That's bond math. Silicon Valley Bank's bonds were paying 1%, 2%, then the Fed raised rates to 5%. Suddenly their bonds were worth 30, 40% less than what they paid. On paper, they had $42 billion in unrealized losses. $42 billion. But they didn't have to recognize those losses because they classified the bonds as held to maturity. As long as they held them, the losses stayed hidden. Then depositors got nervous, startups were burning cash, they needed to withdraw funds. Silicon Valley Bank had to raise liquidity, they had to sell bonds. And when they sold, the unrealized losses became realized. The capital cushion evaporated, depositors panicked, a bank run started. $142 billion in withdrawal requests in a single day. The bank couldn't meet demand, FDIC seized it, game over. Now here's what matters. Silicon Valley Bank wasn't unique. They weren't doing anything wrong. They weren't taking crazy risks. They were doing exactly what every other bank was doing, holding long-term bonds bought at low rates. And every other bank has the same problem. Unrealized losses, massive unrealized losses, hidden in plain sight, on their financial statements, public information. Anyone can see it, but nobody's paying attention until they do. Let me show you the numbers. Because this is not a theory. This is reported data. FDIC data, Federal Reserve data, public filings. As of the fourth quarter 2025, U.S. banks hold $847 billion in unrealized losses on securities. $847 billion. That's across the entire banking system. Commercial banks, regional banks, even the big four, JPMorgan, Bank of America, Wells Fargo, Citigroup, all of them sitting on unrealized losses. Let me break that down by institution. JPMorgan Chase, the largest bank in America, $32 billion in unrealized losses on available for sale securities. Bank of America, $97 billion, $97 billion, nearly $100 billion in losses they haven't recognized. Wells Fargo, $41 billion, Citigroup, $28 billion. And those are just the big four. The regional banks, much worse. Charles Schwab, $27 billion in unrealized losses. Their entire market cap is $95 billion. Unrealized losses equal to 28% of their market value. State Street Corporation, $18 billion in unrealized losses. Market cap, $28 billion. Losses equal to 64% of market value. Now, you might be thinking, these banks are still operating. They're still profitable. They're still paying dividends. What's the problem? The problem is the same problem Silicon Valley Bank had. These losses are fine as long as nobody needs liquidity, as long as depositors don't withdraw, as long as the bank doesn't have to sell. But the moment something triggers withdrawals, the moment confidence cracks, the bank is forced to realize those losses. And when they realize the losses, their capital disappears. Let me show you how this works with a simple example. Imagine a regional bank, call them Midwest Bank. They have $10 billion in deposits. They're required to hold $1 billion in capital. That's a 10% capital ratio. Standard regulatory requirement. Midwest Bank holds $8 billion in bonds. They bought those bonds at par in 2021. Today, those bonds are worth $5.6 billion. That's a $2.4 billion loss. But it's unrealized. So on their balance sheet, the bonds are still listed at $8 billion. Their capital still shows $1 billion. Everything looks fine. Now imagine depositors get nervous. They start withdrawing. Midwest Bank needs cash. They have to sell $2 billion in bonds to meet withdrawals. But the bonds aren't worth $2 billion anymore. They're worth $1.4 billion. They take a $600 million loss. Their capital drops from $1 billion to $400 million. Now their capital ratio is 4%, below regulatory minimum. Regulators step in. They tell Midwest Bank, raise capital or we shut you down. Midwest Bank tries to raise capital. But investors see the unrealized losses. They see the bond portfolio. They know if withdrawals continue, more losses are coming. Nobody wants to invest. The bank can't raise capital. Regulators seize it. Another failure. This is not a hypothetical scenario. This is the exact mechanism that killed Silicon Valley Bank. And it can happen to any bank with large unrealized losses. Now let me show you which banks are most at risk. Because not all banks are equally exposed. The banks most at risk are the ones that bought the most bonds in 2020 and 2021, the ones that loaded up on long-duration securities when rates were zero, the ones that chased yield by buying 30-year bonds, mortgage-backed securities, agency debt. Regional banks are the most exposed. Why? Because they don't have diversified business models. They rely heavily on deposit funding. They hold large bond portfolios for liquidity. And they don't have the scale to absorb large losses. Let me give you a list of banks with the highest unrealized loss ratios. These are banks where unrealized losses exceed 20% of their tangible common equity. 20%. That means if they had to realize those losses, they'd lose 1/5 of their capital. Valley National Bank. Unrealized losses, $1.9 billion. Tangible common equity, $6.2 billion. Loss ratio, 31%. Zions Bank Corporation. Unrealized losses, $3.4 billion. Tangible equity, $7 billion. Loss ratio, 49%. Nearly half their capital. Key Corp. Unrealized losses, $6.8 billion. Tangible equity, $14 billion. Loss ratio, 49%. And these are just a few examples. According to FDIC data, there are over 150 banks with unrealized loss ratios above 20%. 150 banks. Any one of them could be the next Silicon Valley Bank. Now here's the critical question. What triggers the collapse? What makes depositors panic? What forces banks to sell bonds and realize losses? There are three main triggers. Trigger 1, interest rate shock. If the Fed raises rates again, bond values fall further. Unrealized losses grow. Banks look weaker. Depositors get nervous. Withdrawals start. Trigger 2, economic downturn. If unemployment rises, if businesses fail, if loan defaults increase, depositors worry about bank solvency. They withdraw funds to protect themselves. Banks need liquidity. They sell bonds. Losses get realized. Trigger 3, contagion. If one mid-sized bank fails, depositors at similar banks panic. They don't wait to see if their bank is safe. They withdraw immediately. Better safe than sorry. That's what happened in March 2023. Silicon Valley Bank failed on Friday. By Monday, depositors were pulling money from every regional bank in the country. Signature Bank failed Sunday. First Republic failed 2 months later. Contagion. And here's what makes this so dangerous. The current environment has all three triggers active. Interest rates are still elevated. The Fed might have to raise again if inflation resurges, or even if they just keep rates steady at 5%, the unrealized losses don't go away. They sit there, waiting. The economy is slowing. Leading indicators are turning negative. Consumer spending is weakening. Corporate bankruptcies are rising. Commercial real estate is collapsing. Loan defaults are increasing. Banks are under stress. And contagion risk is high because everyone remembers March 2023. Everyone saw how fast Silicon Valley Bank collapsed. Everyone knows it can happen again. The moment one bank wobbles, depositors everywhere will panic. Now let me show you why the $847 billion number is actually understated. Because there's another category of losses banks aren't reporting at all. Unrealized losses on loans. Banks hold trillions in loans. Commercial real estate loans, corporate loans, consumer loans. And many of those loans are worth less than their book value. A commercial real estate loan made in 2021 on an office building. That building is now worth 40% less. The loan is underwater. But the bank doesn't mark it down. They keep it at par. As long as the borrower keeps paying, the bank pretends everything is fine. But what happens when the borrower defaults? When the loan goes non-performing? When the bank has to foreclose and sell the property? They realize a massive loss. According to industry estimates, banks are sitting on over $200 billion in unrealized losses on commercial real estate loans alone. $200 billion. That's on top of the $847 billion in securities losses. Added up, over $1 trillion in total unrealized losses across the banking system. $1 trillion. Now here's the most important part. The part that determines whether this becomes a crisis or just a manageable problem. Time. If interest rates come down slowly, if the economy stays stable, if no major shocks occur, banks can work through this. They can hold the bonds to maturity, they can restructure bad loans, they can rebuild capital over time, slowly, painfully, but survivable. But if something breaks, if a trigger event happens, if confidence cracks, there's no time. Bank runs happen in hours, not days. Hours. Silicon Valley Bank went from operating normally on Wednesday to seized by regulators on Friday. 48 hours. In a modern banking system where deposits can be withdrawn with a phone app, where news spreads on social media in minutes, bank runs don't take weeks. They take hours. And here's what regulators are terrified of. A synchronized bank run. Not just one bank. Dozens. Because if depositors panic at multiple banks simultaneously, there's no way to stop it. The FDIC doesn't have enough resources. They insure $9 trillion in deposits. They have $124 billion in reserves, 1.4%. If even 5% of insured deposits need to be covered, the fund is empty. The Fed can provide emergency liquidity. They did in March 2023. They created the Bank Term Funding Program, gave banks loans against their bonds at par value, pretended the unrealized losses didn't exist, bought time. But that program is temporary. It doesn't solve the underlying problem. It just delays the reckoning. And if the crisis is big enough, if enough banks need support simultaneously, even the Fed's tools might not be sufficient. So here's the timeline. Here's what could happen. Stage 1, stability. This is where we are now. Banks have unrealized losses, everyone knows. But as long as interest rates stabilize, as long as the economy doesn't crash, nothing happens. Banks limp along, profitability is weak. But they survive. This stage can last months, maybe even a year or two. Stage 2, trigger event. Something breaks confidence. Maybe a mid-sized bank fails. Maybe a major commercial real estate default. Maybe an economic shock. Maybe geopolitical crisis. Doesn't matter what. What matters is depositors get nervous. Stage 3, withdrawals begin. At first, it's orderly. Large depositors, corporations, they quietly move funds to bigger banks, from regionals to the Big Four, from the Big Four to money market funds. Flight to safety. Stage 4, the run. Withdrawals accelerate. Banks need liquidity. They start selling bonds. Unrealized losses become realized. Capital erodes. More depositors panic. More withdrawals. More bond sales. The doom loop. Stage 5, contagion. It's not just one bank anymore. It's dozens. Regional banks across the country facing runs. Some fail. Regulators seize them. Depositors at other banks panic. Withdrawals spread. Stage 6, systemic crisis. Credit markets freeze. Banks stop lending. Businesses can't get financing. Payrolls get missed. The real economy seizes. Stage 7, emergency intervention. Government guarantees all deposits. Fed provides unlimited liquidity, massive money printing. The crisis gets contained, but at enormous cost. Inflation surges, dollar credibility damaged. The system survives, but fundamentally changed. This is not a prediction. This is the pattern we've seen before. 2008, the savings and loan crisis of the 1980s, the bank runs of the Great Depression, same sequence, same stages, different names, same outcome. Now let me address the counter-argument, because I know what you're thinking. But that program is temporary. It doesn't solve the underlying problem. It just delays the reckoning. And if the crisis is big enough, if enough banks need support simultaneously, even the Fed's tools might not be sufficient. So here's the timeline. Here's what could happen. Stage 1, stability. This is where we are now. Banks have unrealized losses, everyone knows. But as long as interest rates stabilize, as long as the economy doesn't crash, nothing happens. Banks limp along, profitability is weak. But they survive. This stage can last months, maybe even a year or two. Stage 2, trigger event. Something breaks confidence. Maybe a mid-sized bank fails. Maybe a major commercial real estate default. Maybe an economic shock. Maybe geopolitical crisis. Doesn't matter what. What matters is depositors get nervous. Stage 3, withdrawals begin. At first, it's orderly. Large depositors, corporations, they quietly move funds to bigger banks, from regionals to the Big Four, from the Big Four to money market funds. Flight to safety. Stage 4, the run. Withdrawals accelerate. Banks need liquidity. They start selling bonds. Unrealized losses become realized. Capital erodes. More depositors panic. More withdrawals. More bond sales. The doom loop. Stage 5, contagion. It's not just one bank anymore. It's dozens. Regional banks across the country facing runs. Some fail. Regulators seize them. Depositors at other banks panic. Withdrawals spread. Stage 6, systemic crisis. Credit markets freeze. Banks stop lending. Businesses can't get financing. Payrolls get missed. The real economy seizes. Stage 7, emergency intervention. Government guarantees all deposits. Fed provides unlimited liquidity, massive money printing. The crisis gets contained, but at enormous cost. Inflation surges, dollar credibility damaged. The system survives, but fundamentally changed. This is not a prediction. This is the pattern we've seen before. 2008, The savings and loan crisis of the 1980s, the bank runs of the Great Depression, same sequence, same stages, different names, same outcome. Now let me address the counter-argument, because I know what you're thinking.